We are going to talk about that accounting issues, that how accounting and IFRS knowledge is utilized when we are doing a question in exam on audit risk in AAA. So the point is this audit risk or risk of material misstatement. So accounting issues is the core part of that question. And in the question one of your paper, it is tested for 18 marks to 24 marks on average. Now, so how an accounting issue should be discussed? How a matter should be, explained in exam from the scenario. So first of all, the we need to discuss the materiality of the matter, that whether the amount involved in that accounting issue is material to financial statements or not. And if it is material in amount, then of course we have to explain that. And the second is accounting treatment, that we have to give the accounting treatments from the relevant chunks, relevant, few lines from the relevant IFRS accounting standard. And then we have to apply that relevant chunk to the scenario, that scenario information, that how it is applicable, whether the given treatment, the treatment which has been done by the management, whether it is accurate or not. We have to apply IFRS knowledge to that scenario based specific information. And then if that is clearly incorrect treatment done by the management in the financial statement, we will tell its impact on financial statement. That which specific items in the financial statements are understated, which items are overstated, specific items. But if it is not clear from the scenario that the treatment done by the management is correct or incorrect, then we discuss the risk of incorrect treatment, and then risk of understatement and overstatement of item in the financial statements. So MTRI approach, MTRI scenario I have mentioned, that sometimes students discuss materiality, they tell treatment as per IFRS, they tell risk and impact, but they don't link that to the scenario. Seem like they are just discussing IFRS knowledge and the risk in general and impact as well. So they don't apply that to the scenario, and hence they lose marks over there. The next point. So let us learn it with example how it is to be applied. So it is given here that during the transit, the ship carrying the goods was involved in an accident which destroyed the entire supplies of the goods. Mercury Company's director has arranged insurance on the shipment of goods, and policy states that 80% of goods destroyed are covered by the insurance. The latest correspondence from the insurance company was an informal email that claim has been received and was due to be processed. These purchases are made in Mercury Company's operating currency. So this is basically one of the latest past exam question from where I have picked this point. So there is an issue. First of all, we have to discuss that how much is the 80% of goods. If we read the scenario, there is given total goods value was 12 million. So 80% of that is 9.8 million. Okay, so amount, materiality need to be discussed. Then we should identify which accounting standard it relates to. I have not written the answer. I'm just reading the scenario and trying to rationalize and trying to actually figure out what need to be written about it. So IS 37, contingent asset, maybe some point regarding the insurance amount receivable. means likely to be received. So that has to be discussed over here. So now let us move and talk about that how this point has to be discussed. So here is the answer actually, that the directors, so you see here, this is the point where I have discussed materiality. The insurance policy on the shipment of the goods destroyed. A brief introduction, which is 80% of the goods are recoverable, which is 9.6 million, and which is much above the materiality threshold, which we discussed actually at the start of the question. So it means it is material. So materiality M. Now, so of an informal email now scenario have been received, which means they are inflows are highly probable. Now, what IFRS says an asset can be recognized only. This is the relevant chunk of IFRS. Treatment. If it is virtually certain to be received. So now apply no formal communication. So inflow is not virtually certain. So, one point I discussed from the IFRS and immediately apply it to the scenario and so on. So the info, so treatment, so M, this is M, this is treatment applied to the scenario. The informal communication give rise to a contingent asset as per IAS 37, which should be disclosed in the financial statement disclosure. What should be the accurate treatment? There is risk that now risk. So you see, I have validated it from this all IFRS based discussion applied to scenario, which student miss actually. Student don't give IFRS reference or they don't apply it to the scenario. So the risk is that the inadequate disclosures may have been made relating to the contingent asset, or incorrect treatment may have been done. So simple is that. So this is how audit risk or risk of material misstatement need to be discussed. Now, so MTRI, so impact as well has been discussed. Now, another scenario we will talk about. Now, so the customers can pay as they go for appointment and treatment of the animals, and they can take out an annual packed healthcare plan which covers the cost of essential vaccination and quarterly health checks. Yes, the pet healthcare plans are extremely popular as they offer goods value for money to the customers. An annual income from the sales of these plans historically 10% of the company's revenue. The company's accounting policy to recognize the revenue from the sale of healthcare plan on the date when the healthcare plan commences. Now, I am reading it and I'm trying to MTRI, materiality. 10% of the revenue an item, which is material. So we have to check what is the total revenue and what is 10% of that and whether it is above the materiality threshold. Then which IFRS applies? IFRS 15, revenue recognition. We know that. So that when performance obligation is satisfied, then it should be recorded. Okay. So they have received in advance and recording everything. So it appears to be incorrect treatment. Now, so I have given an answer from one of my students who solved this question, this part, and it was incorrectly done. Now, so you see here what the student has done. The accounting policy of the company is to recognize the revenue from the sale of on the date the healthcare plan commences. There is a risk that revenue not recognized correctly as per IFRS 15. It revenue can be recognized too early to the plan or at the end of the plan. There is a risk that revenue are overstated or understated if revenue are not recognized. So what you see here, they have not discussed materiality first of all. Materiality has not been discussed of the matter. Then what IFRS says? Yeah, the student has given the number of IFRS, but what is the criteria to recognize IFRS? That when revenue should be recognized, and what mistake they have done in recognizing that, whether that is against IFRS or that is in line with IFRS, they have not applied. So they have generalized. It maybe can be early or can be at the end, can be understated or overstated. So where it is clear incorrect treatment, you cannot cheat examiner like this. So for this point, this student won't get a single mark. There are normally 3 marks for one accounting issue, minimum 3 marks. Maybe more, sometimes you can scale it, get more than that. Okay, so this student won't get any mark. So how the point should have been discussed? Like this. So the healthcare plan is yielding a sale of 10% of our sales. An amount of this year, which is much above the materiality threshold. So it is material to financial statement. So materiality discussed. So the plan covers the cost of essential vaccination and quality. Okay, now the issue has a bit given. What IFRS says, treatment. So materiality, treatment. Revenue can be recognized only when performance obligation is satisfied. And a performance obligation is only satisfied when control of goods is transferred or service is performed. What IFRS says. And now apply to scenario, to the issue. Here in the case of healthcare plan, performance obligation is satisfied over the year and it is discharged over quarterly health checkups and vaccinations. So initially the amount will be recorded. Now you see here how performance obligation is being satisfied. Applying to scenario, this point, and initially the amount will be recorded as deferred income, a liability, and later systematically it will be released in profit and loss as revenue over quarterly health checkups. So this is where performance obligation is being satisfied. But the company here records revenue on the date of its commencement. It is too early at incorrect timing, and hence revenues and profits are overstated and liabilities understated. I will again analyze it. So materiality you can find, treatment only relevant, which is relevant to this scenario. And then there is treatment applied to scenarios that what they have done. And if it is wrong, why it is wrong, using logics, performance obligation details, how they should have recorded it. Yes, and impact, which items are specifically understated and overstated. So this is how MTRI scenario. So this is how it should have been written. I hope this will help you in understanding. So thank you. Follow my page and you will have more access to the more